We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Oliver from Momentum Structural Analysis. Thanks for joining me today again, Michael.
Hi, Tom. Good to be back.
So, you and I have spoken many times before about this idea of a grinding bear market that you expected in the broad indices. So have we seen maybe just the beginning of this, maybe the first taste of it?
Well, yeah, it has been arm wrestling is the phrase we used even when we issued our sell signal in January of last year and February of last year, Nasdaq 100 and S&P 500. They were like 2 months off the high, and we said, that's it. We're going into a bear market because certain things had broken that were not price-based, but momentum-based. But we said, don't expect it to crash. Mm-hmm. This is going to be an arm wrestling match where maybe the first year or so, people are going to be debating about whether it's a bear market or not. Because every other month or so, there's a counter trend rally that makes you feel good. And you turn on your financial TV channels and they keep talking the word bottoming, or even with the question mark, the word bottoming comes up. And so that's where we are. We're in yet another rally right now over the last 3 or 4 weeks. And who knows, maybe it'll go for another couple of weeks. If you go back and look at 2008, we came off a high in October 2007, and you dropped into late in the year. And as soon as we opened the new year, we issued a sell signal, first days of January. So a couple of months off the high. Mm-hmm. And you had a real sharp drop in January, not a crash though, not of that dimension. Mm-hmm. Then a rally into February, then back down into March, made a marginally lower low, and then had a rally that lasted until May. In the May rally, I think it was the May rally, went up and took out. If you looked at a price chart of the S&P, like week to week, weekly mm-hmm. bar chart, you had a staircasing pattern of lower highs. Well, that May rally took out a prominent prior rally high. So not only did you have the arm wrestling decline, but you had one rally that went up and took out a prior high. So you could say, oh, a breakout. If you look at the price charts, it is. And after that breakout didn't really sustain, it took it about 3 or 4 weeks and it rolled over again. That's when the bear market in earnest began, where you started getting more volatile downside, bigger percentages. Mm-hmm. So, I think we're at that point now where it's the next new low in the S&P, next new price low after wherever this rally that we're in now peters out. It's that next new low that starts a tone that people recognize more so as a bear market. Mm-hmm. Now, and you also got to, when you look at the S&P, I know everybody does, it's the broad cricket. But look at the Nasdaq 100, which is really the market. It was the leader on the upside for a dozen years, and it's led the downside on a percentage basis.
Michael, why, if I can interrupt you for 1 second, why is the Nasdaq the leader index, as you said, since about 2009?
Well, its weightings are also within the S&P. For example, you look at the top 3 or 4 weightings of stocks within the Nasdaq 100. There's Apple, Amazon, Microsoft, Google, et cetera. So heavily weighted, heavy percent of that index. And they're also heavily weighted within the S&P, not quite so heavily weighted, but still a huge chunk of what the S&P is. But the Nasdaq 100 went up 16-fold from its 2009 low to its 2021 high, when the S&P went up 7-fold. So clearly it was the leader. Mm-hmm. Okay. Now on the downside, at the end of last year, for example, S&P was down 20%, Nasdaq down about 32%. So again, it's leading the new trend. And I think that is the index to really watch because it will remain the leader. You're not going to suddenly have it supplanted by a material sector or something. You might want to dream on about that, but it's going to be the leader. And if it continues to act the way it does, which is pathetic compared to the S&P, mm-hmm. Your market's pathetic. Now look at Nasdaq right now. For example, Friday's close. You've had like a multi-week rally, just like the S&P. But if you go horizontally on a price chart, compare Friday's close to where it was in June, which tended to be a fairly important low for many indexes, S&P on its price charts, for example. That's where you are. Whereas the S&P is a nice handful of percentage points above the June low. So since June, as we've been doing this stuff, S&P's actually gained versus where it was in June, whereas NASDAQ, all this effort has been spent rallying, and it hasn't gone anywhere. So, the clock is ticking. This rally we're in right now either produces something dramatic, and I don't mean back into a bull market, but a rally that impresses people, like take out a prior rally high. Now, for the S&P 500, it's trading around 4,000. That prior rally high was a month or two ago at 4,100. So go up another 3%, take out that high, and let's see what's on the other side. Is it further buying, or is it nothing? And if it goes up there and takes out that high, and again, we're not arguing it will or must, but it could. And if it does, that would be a great litmus test, because if that breakout in price fritters away over the next week or two after breaking out, then it's a dud. The next rollover is likely to put you into a different type of downside, different type of tone. We noticed the opposites going on in silver and gold. After getting beat up through a bottom of a price range that they had lived in from mid 2020 through late 2000, through summer of 2022, a 2-year range, up and down, up and down. They burst through the bottom of that range. Gold had multiple lows around 1670. March 2021, August 2021, June or July of 2022. You blew it out, and you did what? You dropped 3 whole percent and went to 16, 17. And now, several months later, where are you? 1920. Okay. So there's an example of price blowing out something, in this case, downside. It didn't matter. It was a joke. And then suddenly dynamics the other way began. Well, we're kind of looking for that possibility in the stock market where they go up and they take out some kind of obvious price high. And if that doesn't succeed and they roll over, then expect dynamics to renew on the downside. And maybe the behavior of gold is inverse to that, which we think it is, to that type of behavior, in which case we could have speedier markets this year.
Speedier meaning more volatile.
More volatile, get more done in a shorter period of time, either whether upside or downside.
So how do you see the rate hikes affecting the situation going forward, Michael? Does the full effect of how fast the Fed has hiked rates have yet to be felt by the markets and companies' earnings? I
think so. I think that they looking for the quote data points that the Fed likes to look at, the old orthodox stuff they look at. They're very much lag data points. This time they're really lagged. I mean, that unemployment number, if you break it down and really look inside of it and see what's getting good unemployment, what's not, it's I don't want to diminish it, but it's less important jobs. Okay. It's not core economic jobs. And those type of things, when they change, can change dramatically. In other words, if there's a catch-up involved, a lagged effect where, they get whacked, but you don't feel it for a while, and then suddenly they feel it. You could have a dramatic change in those numbers that is, again, lagged to the reality. And it's at that point, and I think especially not just the data points, but when certain market arenas come under pressure that the Fed doesn't like, it's uncomfortable with. And that would be, of course, financial type stuff. Fed probably doesn't care whether this or that retailer goes under or this or that tech company. But if you start to talk about financial companies, or Janet Yellen, for example, a month or two ago, issued a statement with great sincerity and concern. She said she was very concerned about the lack of liquidity in the U.S. government bond market. You get the biggest market, most important market in the world, arguably, at least for many, is now illiquid. Well, that's the worst word you can use in a market. market can go down big or up big, but being illiquid is highly dangerous. Remember back to mortgage-backed securities. Once the Fed came in to support them in late 2008, suddenly that market got illiquid. Why? Because it was a monopoly buyer of the asset. Nobody else was buying because they knew the prices they were paying weren't real, they were artificial, created by the government. So the market became illiquid. And what happened? It collapsed. If the U.S. government bond market, like the gilts in England recently, you can't have that happen. And when that stuff starts to happen, even if it's not a quote official data point, that's when the central banks quietly at first, admittedly, they're not going to come out pulling their hair out, okay, but behind the door, they're going to be very concerned. And the Secretary of Treasury, who's not on the Fed, is going to be telling them, listen, guys, you got to stop this. And the same type of action in other countries. So that's something to watch. And right now, the bond market, U.S. government bond market, look at, for example, 30-year bond or TLT, the popular ETF for long-dated treasuries. They're in a rally mode. They had a rally a couple of months ago that they're still below that rally high. They may go up and nip out that rally high. There's a lot of people thinking, oh boy, rates have peaked. We don't think so. We think rates have, the decline in price in T-bonds that we saw a year ago even, blew out the momentum trend structure and integrity of the uptrend of the prior decades. So you don't just go down and break it once and that's it. You break it, then you have a rally that's meaningless, then you have another leg. So we're going to have further decline in bonds, rise in yields. But right now we're in a pause where we're getting an upside correction, where there's hope again, that, oh boy, maybe we've seen the worst. I doubt it. But that's a market to watch, the T-bond market, because as it goes, and especially if that term liquidity is used again by Yellen, that's the key to watch.
So, Michael, when we think about, let's say, the dynamics of the Fed needing to support the bond market, what does that in turn do to the dollar? Is that more of a confidence game, or is it a very linear relationship?
Well, I mean, the funds have to come from somewhere to support the dollar. And if the foreign buyers, which used to be there, are divesting themselves consistently of their T-bond holdings, then if there's another wave of needed demand for U.S. bonds to support them, to keep the long end of the market from going higher in yield, remember, the long end is somewhat beyond the control of the Fed. They control Fed funds rates, stuff like that. But the longer end of the market is a dragon that's under its own control. And so if the Fed has to throw capital behind that thing, it's going to have to be fabricated. So, they're going to have to make money, create money to do that. And so underlying inflation is going to return. And I think that's what gold sort of knows. And that's why gold, for example, in the first year of the asset downturn, and again, we argue it's the biggest asset bubble in U.S. history. It makes 1929 bull market peak look like a pipsqueak on a ratio basis. It was like a tripling or a quadrupling of the stock market back then. We had a 7-fold and a 16-fold. Okay, or the dot-com bubble doesn't compare to the bubble of that we just saw, or the 2007 real estate bubble high. They don't compare to what we just saw. So as that bubble unravels, the consequences are many and diverse. And some of them will be dangerous for the central bank's point of view, in which case the Fed's going to have to lose credibility. And already to some extent they are. A lot of Fed supporters who were initially for the raising of rates. Now suddenly it's gone too far. Feds, it's over. The Fed's already done the damage. This is going to be hell. Nouriel Roubini is an example, who's generally a pro-Fed economist. Now he's saying this is going to be the biggest disaster in history, with real world in the street type consequences. El Arian also thinks this is, it's gone beyond the beyond. This is going to be terrible. And that's what we've been thinking all along too, is the ultimate outcome of this is going to be real world events, not just market events.
So, how do you see the path forward for the Fed here? Are they going to be able to make a couple more, 50-point rate hikes as they signaled?
I hope they do. I mean, they pricked the balloon already, and once you prick a bubble and it breaks, and by our definition, our momentum, long-term momentum measurements, it's broken. Mm-hmm. Once they break, they unwind. And the central banks invariably, if you go back and look at the bear market after the dot-com top, or you look at the bear market after the 2007 peak, the Fed came in and tried to stop it at some point. Mm-hmm. Not at the tail end, but halfway through the bear, they tried to come in and defend. It didn't work. Or the market ultimately expunged itself of prior errors and probably overshot itself on the downside. When you go excessive one way, quite often you go excessive the other. That's the way markets are. And so we think we're in the early phase of the downturn. And so far, it's not alarming to the Fed. And they feel, we can do another half. And, they'll slow up. There's no question. Mm-hmm. But it doesn't matter. They've already gone so far. And if they add another 0.5%, it's just going to make it worse. Though, really, they've done their job. And now they're going to have to revert. And I don't know how they're intellectually going to do it without losing credibility, where we went one way for like 10 years, money was free. Mm-hmm. And then we went another way. And now we're going to have to go another way. Pretty soon people are going to look back and say, geez, these guys don't know what they're doing. Do we really need this institution? Mm-hmm. Or would maybe a gold-backed currency be more stable? All these questions are going to start to come up. My bet is you won't have a Fed in several years.
Interesting.
There'll be enough public pressure and doubt and skepticism where it just won't have enough credibility to persist. Remember, it's only been around 100 years. Mm-hmm. It's not like some eternal thing.
So, when we think about how they're going to react, obviously using the only two tools that they have by quantitative easing and slashing rates again, do you think that they're going to be so far behind the eight ball, so reactionary instead of proactive this time, that they're not going to be able to really have the effect that they need and want to once they step back in?
Well, if they create another river flow of liquidity, mm-hmm. which they will, and I say they, I include the Bank of Japan, EU, and so forth, primarily the developed countries, not so much China or a lot of emerging markets. They didn't do what we did. Mm-hmm. China didn't have a bubble. So all the talk about a bear market in China, it's halted just above a number that would have put us into a deep bear camp. It halted a couple of months ago at a level where we said, don't close the month below there, and they didn't. And they've rallied since. Mm-hmm. But even if it does enter a coincident bear market with the US, it's going to be a slow and sluggish bear market. It's not going to be a bubble breaking. It's just going to be a grind. And percent-wise, it's not going to be anything like ours. Why? Because they didn't have a bubble in the first place. And that's even true with Europe. If you look back at where the European indexes are now versus 2015, there's not been a bubble. Yeah, they've been in sync with the US on the upside, but they didn't have a bubble. We're the ones with the big bubble. So we're the ones that are going to pay the dues because we're the ones with the most built-in errors over the past dozen years. Mm-hmm. So we'll be the standout. And they won't be able to reverse it. What they'll do is when they create a new river flow of liquidity, investors and asset managers will utilize that river flow, but they're not going to put it where the Fed wants it to go. This is going to be more like late 70s, where after the stock market had its collapse into 1974, after a bull market peak, it rallied, and then it went sideways to 1982. It was a total wasteland. Now, that bear market in the mid-70s was not a bubble breaking. It did not achieve what we did, so it wasn't as bad. But still, asset managers and investors, simply stocks weren't in the game. Mm-hmm. I remember being a broker back then in the brokerage side of the business. This is you're talking, late 70s, early 80s. Phones weren't ringing for the stockbrokers. In fact, they were out to lunch all the time. I was a commodity broker. I was doing the greatest amount of business, and I'm not a great salesman. And it's because people were moving money into harder assets. Mm-hmm. And I think that's what's going to happen this time. So if they start pumping money again to save muni bonds or to save high yield corporate debt or to save the U.S. Treasury market, they're going to create the liquidity, but it's not going to go precisely where they want because investors are just tired of that stuff. 2022 was a great lesson. Down on the year, 20% S&P, down on the year, 30-something% bonds, down on the year, 30-something% Nasdaq, down on the year, muni bonds, down on the year. All the paper assets were down double digits. And gold closed unchanged. It was a relatively safe place to be. I mean, at the end of the year, it closed unchanged, silver up 3%, and the commodity index was up 13%, despite being in a sell-off. So all their attempt to slow the river flow didn't have the effect they wanted. It went elsewhere. And the same is true when they increased the river flow. It's coming back into the markets, but I almost guarantee it's going into gold.
So, Michael, when we think about, let's say, as you mentioned, the commodity index being up 13% over last year, even being down from its highs, we've seen this spike in inflation. Do you think that's the precursor for much higher inflation as we see the costs of these raw products really play into everything?
Yeah, and if you define inflation as like commodity-based type stuff, CPI type stuff, we define inflation via monetary factors. And inflation's been ongoing since 1959. Every 10 years, the money supply almost doubles. Okay. Now, in the last decade, it's gone parabolic. That will return because the central bank will have to do that. This time it shows up in the things they call inflationary, like commodity-based assets, the price of eggs, gasoline, and so forth. Too many people right now, I think, are focused on what had been the leadership in the first bull wave of commodities. Now, that bull wave began by our metrics in October of 2020. We put out a report called Commodity Explosion Coming. We didn't say commodity upturn. We said commodity explosion. The Bloomberg Commodity Index then was just above 70. Its low had been in the 50s. It shot up to 140 by early 2022. What happened in early 2022? Russia invaded Ukraine. But 90% of the entire commodity move, including oil, had already occurred before that invasion ever happened. So you can't blame it on Putin and any strangling effect that might have had on energy movement or grains. That had already occurred in the price of grains and oil before Putin even stepped across the border. So that's a nice excuse for governments to use. The real cause was the monetary expansion. It didn't go where they wanted it to go. Stock market, it went into commodities, finally, or underpriced commodities. Now we've had a correction, an arm wrestling correction. Oil's now at 70 to 80 bucks. It had a spike up to 130. Natural gas got up to 10. It's now under 4. But you look back at the last 4 or 5 years of price action, those prices, 70 to 80 oil, under $4 natural gas. Natural gas is only barely back below the highs of the prior half dozen years. So it's still at a high level compared to 3 or 4 or 5 years ago. Yes, it had a sharp pullback. We suspect it's not going to go much lower. But energy led the way in the first commodity leg. We think the second commodity leg is not likely to be led by them, but they will participate and be to the upside. But on a percent basis, we think it's highly more likely to be the food category. Grains, sugar, for example, which is, well, the price of gasoline at the pump has dropped and people are smiling. The price of eggs, has gone up. The price of ground beef, cattle's in stratospheric highs right now. So almost it's new highs for the last years. Sugar, new highs for the last 5-6 years. Nobody's talking about that. They're talking about, gasoline's come down. Yeah, great. Meanwhile, that which you put on your table is compensating for it. So, it's this or that, but you still got the rising price level, which affects the average family. And also we have the consumer credit. It's gone through the roof. And out of dependency for the need of cash flow, they didn't have the savings, they had to borrow it. And now suddenly you're at a point now where things aren't getting better really for them. So you're going to have delinquencies rise. You're going to have car repossessions. Oh man, you're going to have all kinds of things that the Fed will then pay attention to. Recessionary type events.
Mm-hmm.
A hint of that, Wells Fargo. They're out of, as best I know, they're totally out of the mortgage market. They announced that like a week ago. Gone. Well, what are they afraid of? Why did they make that strategic decision? What are they anticipating? I suspect they're dead on.
Mm-hmm.
Dead on right.
Yeah, it seems like, as you're saying, these consumer staples like food are following many things that, again, we talked about before, lack of fertilizer, for example, and how that's going to affect beef prices, grain prices going forward. And these trends don't seem, they're not necessarily a mystery, right?
No, they're not. And it's not just because of specifics to a market. For instance, when we said commodity explosion in October 2020, it was every commodity. You could have thrown a dart. Cow manure up, apples up, everything up. It's not because you had a specific that was, you didn't have a wheat route that caused wheat to go up, or anything of that sort. It was just everything went up at once. And even when they went to 140 on the Bloomberg, it was a brief spike, by the way, and it then settled back around 100 area, give or take. You didn't have a specific event that you could say did that. And even the Russia excuse was at the absolute tail end of that entire move. So I don't know that you need a specific excuse. I think it's more of assets are moving from a risk area, a risk reward area that they now perceive to be less rewarding, more risky stocks, other paper assets, government bonds of all levels, into an asset category that's still, when you look back at price levels of where the Bloomberg was in 2008, for example, we got up to 140. Heck, it was up in the mid 200s back then. Mm-hmm. So even though, yes, we have a rapid change year over year, which is the way they like to measure this stuff. Oh, biggest inflation we've ever had. The price levels aren't, though. We're not back to the price levels of commodities in 2008, for example. We're only halfway back. So when you look at it, not a year-to-year net change, which is a convenient way to say, oh, it's been pulling back here because this month last year, it was, et cetera. It's the general price level is still low for commodities historically. And so there's plenty of room to run we think there's a second leg coming. And that's really going to mess up the Fed's integrity, their sense of being of value. Because if all they've done is break stocks and commodities enter a new wave, and so all this recent cheering about the pullback in some commodity prices ends, and suddenly there's a new wave up in commodities, then people are going to say, hey, listen, this policy move by the Fed, it didn't have the effect at all that they told us it would have. Mm-hmm. So they're going to lose more credibility as these events unfold, and perhaps to the point where we don't have a Fed. And we have instead this country, that country, suddenly a trend sets in motion where perhaps there's gold-backed currencies again.
Mm-hmm. Well, unfortunately, Michael, I don't think, your average American is paying attention to what the Fed is doing, and they also have a very short memory. So I don't know that they're going to be able to kind of link those two things to really have a mainstream view that the Fed is to blame for these bubbles and the effects that they've had.
But enough economists and academicians will. And I don't think it needs public consensus to make these kind of changes. Mm-hmm. That if you get enough influential academicians and economists and even politicians to suddenly make the decision, hey, this just hasn't been working. We need something else. Mm-hmm. And somebody points out to them, hey, you remember when? Okay. Then perhaps we go back that way. We go back toward some less fiat type currency. And it may not begin here. In fact, it probably won't. It'll probably begin elsewhere. Mm-hmm. And I think that's the potential for the demise of the dollar also, in that what does the world need a reserve currency for? I mean, we're not like 200 years ago when the pound sterling was it, or whatever. The world can have 2 or 3 viable, internationally tradable, recognizable money units, some of which might even be backed by gold. Who knows? Maybe the Chinese yuan will be at some point. The dollar's going to lose its dominance. But whether it gets kicked totally off the list, that's a different issue. But being the sole reserve currency, I think, is going to end. And I think we're in the process technically now, the dollar. We got bearish. Dollar index shot up to 100, almost 115 several months back. It took out a range. It was a price range, a very dull, narrow price range that had prevailed from 2015 through 2020, early 2022. So 7 years wide. And the upper end of that range had been 103.5 area, 103.5 area, twice. It punched through there in March of last year and ran up to almost 115. And everybody said, "Oh boy, the dollar's dominant. It's gonna be the currency for et cetera." Everybody got on board. Well, when it dropped back down under 111, so 3 or 4 points off its high, we turned major bearish again because we momentum broke some big stuff. Price didn't at that point. Momentum did. And we said, "You're going down to 103 again, quickly." Well, that's where we went. We're down to 103.5. And for 4 weeks, late last year, pounded on the 103.5. Why? Because price chart guys are looking at their price charts and they see these old 2 highs of the range that had prevailed. A very narrow percent range, by the way. One of the least volatile ranges in dollar history. That's 7 years. It almost was asleep. Well, gold doubled during that time. They bought it on top of that range, and now suddenly we've traded under 102. So now they realize, oops, that upside price breakout was a fake out because the old highs didn't hold as support. Well, flip it over. That's exactly what gold did. Except it wasn't a 7-year wide range. It was a 2-year wide range. It's 1670, broke through it, said, right back above it. And what do? We gush back to the highs. It wouldn't shock me that the dollar, which is now under very sharp pressure, suffers a lot more in the next several months. Gets it way down below, maybe even down under 100, and then people start to say, what's going on here? And what's going on is partly an issue of the central banks where the perception was, the BOJ is going to stay free money forever. No, they suddenly started to join the game, even if slightly, the tightening game. And EU is trying to compete with us to some extent in the tightening game. So suddenly the Fed's tightening doesn't look so isolated. And so that was part of the reason the dollar going up is, they're giving us higher rates compared to these other guys. All of a sudden that perception is shifting and the support of the dollar is evaporating. And this could open up to a world of multiple reserve currencies.
Yeah, kind of on that idea of how antiquated that idea is, Michael, is the other part of the SWIFT system still being the only real way to transfer large amounts of money around the world, and how, again, antiquated that system really seems to be, considering we have such more efficient alternatives now. There's just so many factors that point towards the need for change in that system.
Yeah, and I think the market reality, the trading market, the dollar index dropped. By the way, dollar index is 57% the euro. And when you add the yen, it's like over 60%. It's just those 2 currencies. So really the dollar index is the euro upside down. So it's really not much of an index, when one unit is 57% of it. But anyway, I think that the drop in the dollar itself in the marketplace is causing the intellectual rethinking as well. You get smacked in the face by market reality and you start to think, well, what's really going on here? And people think broader and they take into account the type of stuff we've been talking about.
So when investors are talking about and looking at commodities, why do you think that too many of them are focused too heavily on energy?
Well, it's because, a lot of people, when they find a leader in a given area, they continue to, put dominance on it. It's I think that's part of the reason. They were fixated by the extreme strength in energy. Plus, energy affected people more than any other thing in the last run-up. It hurt the average guy going to the pump. Okay, it really hurt him bad. But if it now shifts to food, which arguably is as important, if not more important than fuel, and balances out the pullback in fuel prices, it's not going to much matter to the average guy in the street. He's still getting killed. Mm-hmm. And God forbid that oil starts to regain again, which you probably will, and so natural gas as well, even though not as much as they were. I don't think they'll be leaders the second time. Mm-hmm. It could rotate in the second phase of this bull trend. We think it'll be more likely food type stuff. And well, even copper, base metals. The copper suddenly come back to life big time. So and sort of a lot of the base metal miners have come back to life as well. So that has nothing to do directly with the Ukraine situation. So once they run out of excuses and the public sees that this policy to subdue inflation, as narrowly defined as commodity inflation, isn't working, then skepticism about the Fed rises, but also concern about who's in charge. And if people don't have a sense that somebody's in charge, they start pulling their hair out. And so panic can ensue more quickly that way when you don't have a sense that there's a papa out there. The papa ain't no good. He's not doing his job. He can't do his job. This reality is beyond his ken. Mm-hmm. That's when people start to panic because, people still believe you can't fight the Fed. And that's why a lot of people have been trying to sell gold, thinking that, well, you can't fight the Fed. And if they want to take inflation down, you better sell gold. And, on net on balance, as 2022 went along, gold went up about 10, 12%, down about 10, 12, and came back close unchanged. And now it's up $100 on the year versus 2021 and versus 2022. So something isn't working. And when that happens, people start to panic because their sense of orientation is wrong. And when they don't have a sense of, where is reality, that's when the words like panic start to come into play. Mm-hmm.
Yeah, as you're saying, when people don't feel that there's a papa in control, that there's somebody out there that is going to take care of me, then mm-hmm. as you mm-hmm. say, I think that panic might start to set in. So, Michael, when we're talking about or analyzing the difference between gold and silver's behavior right now, why are we seeing, gold seemingly having more strength than silver at this time?
Well, actually, if it doesn't, it seems that way sometimes. Like, for instance, when we began the new year, silver dropped 3% mm-hmm. back from where it closed 2022. Gold didn't even trade down on the year. So there briefly, silver had a 3% drop. This is a couple of weeks ago. In the third trading day of the new year, January 5th, silver had a drop. 3% down on the year. Gold wasn't even down on the year. So there was a point where what you just said was true. Yeah. But since the close of September, we measure silver's price action versus gold, and we create a spread. We plot it. So silver price is what percent of the price of gold? And recently, in the last year or two, its lows have been down close to 1% of the price of gold. Took 100 ounces of silver to buy 1 ounce of gold. If you go back 50 years and look at that spread, you'll see big swings up and down. And we were definitely at a low level. So during that pullback that silver had in 2021, 2022, the spread came back down to what we would call historically low spread levels in relation to gold. But at this close of September, that spread broke out. Mm-hmm. By our momentum metrics. And sure enough, ever since then, month to month to month, silver's gained versus gold dramatically. Well, you look at it. Gold made a low in the low 1,600. It's gained $300 right now. Okay, we're at 1,900. Silver made a low just above 17. It's trading almost 25%. Is a lot bigger gain for silver. So what's interesting about that spread is, generally speaking, and in fact, almost all the time, when that spread turns into positive trend for silver, it usually converts to also net price positive trend for both metals, with silver leading. When that spread turns negative for silver, as it did in early 2021, Sure enough, what happened was general pressure hit the net price of gold and silver during that period of time, with silver underperforming. But again, when you go back 50 years and look at that spread, there was one time it was at 6.5%.
Mm-hmm.
We'll lift that one off the table. That was an exception. That was in 1980. Since then, silver has reached, that spread has reached near 2.5% to 3%, about 4 or 5 times. So it's not like an irregularity for that spread to go up to 2%, 2.5%, or even 3% of the price of gold. Okay. If gold were just $2,000 an ounce and stayed there, and silver were 2% of that, silver would be $40.
Mm-hmm.
Okay. If you go back and look at gold over that 50-year period, starting in 1970, before gold was even trading here, cash market, you had a 6-fold bull move between 1970 and 1975 peak, when gold was legalized at $200. And you had a bear trend. From the 1976 low to 1980, you had an 8-fold bull move in gold, 8-fold increase in price. From 2000, the year 2000, gold was $250 an ounce. Between 2000 and 2011, you had an 8-fold move in the price of gold, up to $1,920. So far, this bull market, which is ongoing, started from 1,050. So far, we've only had a doubling.
Mm-hmm.
If gold were merely to do what it's done 3 times before in the prior 40 plus years and have another 8-fold move, it'd be $8,000 an ounce.
Mm-hmm. And that was, you recently charted that with your gold monthly ratio chart, right?
Yeah. And if silver were 2% of 8,000,
mm-hmm.
it'd be $160 an ounce.
Mm-hmm.
So if gold is in this bull trend, which we argue was only mildly interrupted with that brief break this summer that took out the bottom end of that quiet range, very briefly, in fact, like 4 weeks, and then right back up, bear trap. And isn't, in fact, still ongoing in the bull market that began from the 2015 price low at 1,050. And gold goes up another 8-fold. Frankly, we have an environment out there that we've already been talking about that could create something far more dramatic. We know that. Mm-hmm. But even if it just did what it's done 3 prior times, almost routinely, and went 8-fold, and silver did something routine, like go up to 2.5% of the price of gold on a ratio basis, something it's done 4 or 5 times, routinely, then you're talking a couple $100 silver.
Mm-hmm.
Silver's in the 20s, a couple $100. You do the math. Okay, so we're focused on silver right now because we think, one, the gold and silver upturn has resumed. We think it had a protracted corrective process, not a bear market between 2020, 2022 low. And if we have just the normality of upside that we've had so many times before, in both in the price of gold, the multiple gains, and in the silver gold ratio, it's not outlandish whatsoever to argue $200 silver.
Mm-hmm.
It's fully within the cards. And especially when you look and flip over all the other things that are going on out there and realize what the consequences could be to this.
Mm-hmm.
So we're most bullish on the monetary metals as far as a category this year, not commodities. Commodities will lag what gold and silver do. And they're not always in sync, by the way. Mm-hmm. People think, well, if commodities go up, that's inflation, that helps gold. No, it has nothing to do with it. Gold looks at monetary policy. Commodities were sideways 2015 through 2020. In fact, there was a slight decline. They were depressed into the hole. Gold doubled. And then when commodities exploded in late 2020, gold had already doubled and peaked. It was in a downside corrective mode when commodities exploded. So don't necessarily try to link the two. But anyway, if we get a second commodity boom, it will merely be on the tails of gold and silver leadership. Mm-hmm. And I think within that leadership group, then, which is now very narrow, gold and silver and their miners, commodities will be a laggard and silver will be the outperformer. And one of the virtues, one of the wins at the back of gold and silver this time around is they don't have an alternative competition. There have been times before when T-bonds were an alternative. So if you didn't like stocks, you could have bought bonds or bought gold and saved your butt. This time, if you bought bonds, you got kicked really bad, even worse than stocks. And there'll be more of that. So gold is now the isolated alternative. So it's like a wet bar of soap that so many hands are going to grab with few alternatives out there.
Yeah.
And that's why our focus in 2023 is extremely narrow on gold and silver, with the emphasis on silver.
So, Michael, in that idea that there's no alternative, one could argue that Bitcoin, in the past, Bitcoin and cryptos in general have taken some of the liquidity from gold as a really, shiny asset that a lot of people chased. Do you think that in that idea that Bitcoin has yet to prove its reliability as that type of asset, as a real alternative to gold for most people, not just people that are trying to chase that momentum?
I think ultimately it will be helped by gold, and we do Bitcoin reports as well every couple of weeks. We just updated in this weekend report, and Bitcoin has crossed through some long-term and short and intermediate-term buy signal levels for us, which indicates to us, yes, you can now start thinking positively about Bitcoin. That doesn't say what the dynamics are going to be. It just says we think that probably it's been beat to the point of possibly the low is in place, and that the bias now is positive zigzag rather than negative zigzag. We turned bearish on Bitcoin more than a year ago when it was coming down through the mid 40,000s, especially in the mid 30,000s. We thought it would go back to 15,000 or so. Well, it got even lower than that. That's a wipe on a percent basis. Go from 70,000 down under 15 is a wipeout. I mean, you might as well go to zero, And we suspected that would happen. Also, back talking about spreads again and the relationship between Bitcoin and gold. There was a period from about 2018 through 2021 where if you bought Bitcoin and sold gold, you made a lot of money. Bitcoin beat the pants off of gold in terms of a place to be. Far greater percent gain. But then more than a year ago, that spread broke down. It happened to break down coincident with our declaring of the top in Bitcoin. So we declared that the top was in place for Bitcoin and a major bear going to happen, but also the spread versus gold broke down. And sure enough, if you bought gold then and sold Bitcoin, you made a ton of money. Okay, mostly being short Bitcoin, somewhat being long gold. Gold still favors Bitcoin. So even if Bitcoin is turning up now, it's lagging gold. It will continue to. I don't think it'll be the best place to be in the next couple of years, but I do think it will be a secondary alternative. And I can't talk about all the cryptos. I mean, there's so many beyond my ken. But we look at Bitcoin, and I think, yes, you're right, that it could prove to be an alternative or a growing alternative, but it's going to take it a while to regain confidence. And its technicals, while they've shifted to positive, they don't look dynamic. I mean, it doesn't look like you're going to explode now. Go back to 50,000 Bitcoin or something real quick. It looks like you're going to have to arm wrestle your way higher. But it does look like a shift may have occurred. And I do think, yes, that could be an alternative over the next year or two. Certainly to those other asset categories, stocks and bonds, but a far lesser alternative than gold and silver.
Michael, one of the last things I wanted to touch on with you here is uranium. Of course, we've seen quite a change with all of the market dynamics that have come into uranium, the supply deficit, all of these things. So how are you guys, even though you're somewhat removed from let's say the day-to-day market issues of uranium, how do you see the uranium price going forward?
No predictions except to say we turned bullish on uranium literally a few dollars off its low several years ago. It was well under 20. I think it was under 20, if I'm not mistaken. We had a couple of buy points, and it exploded since, along with most energy markets. Natural gas exploded, crude oil exploded, so they all exploded. And uranium's been holding better than oil and natural gas in terms of the pullback. It's not been as sharp. It's it's almost, you can't trade the futures. They exist, but the daily volume is sometimes single, that many contracts or something. So it's a nominal contract, and we try to keep up with the data on spot price of uranium 308. futures on the Chicago Merc, NYMEX, and then shown on the Chicago Merc. So we do keep up with it, and every month we update it in our monthly commodity report. And so while it looks positive long term, just like oil does, looks like energy category in general does, it's been holding up well. Mm-hmm. So I think, yes, it has long term further to go, just like energy itself. But the problem is the real thing to look at there, which we do as well, is look at the uranium stocks more than uranium itself. And they've tended to behave somewhat differently than uranium, better than uranium. They were lagged on the breakout to the upside. They lagged uranium, but then they caught up and they're behaving better. To some extent, this is also true with natural gas stocks. Well, natural gas has been pummeled recently. The natural gas stocks have not been pummeled as much. Mm-hmm. So if you're watching uranium, watch it, but remember, it's a highly illiquid futures market. It's almost nominal. And to focus more on the ETF that covers a lot of uranium stocks would probably be a better way to keep track of that energy source.
Mm-hmm. Excellent, Michael. Well, is there anything else that you'd like to touch on before maybe we wrap up today?
Yeah, I think 2023 is going to be a lot of bull trends. They're incremental. They sort of stay incremental maybe until the last few months, and then they go ballistic type of thing. It's like the stock market went up for 12 years, fairly incremental, and it suddenly hit a blow off in 2021. I tend to think 2023 is going to be a very violent year. Downside for some markets, upside for others, where while 2022 may have been incremental, I don't think we're going to stay incremental during 2023 and 2024. And suddenly in 2025, you're going to get this explosion or collapse. I think you could get more volatility this year than most people expect, mm-hmm. whether upside or downside. I think the events that are happening are going to coalesce like very quickly. There was a Monty Python movie I always chuckle about where it was a medieval movie. There's a guard standing outside of a castle with his spear, and he's looking out over the horizon, and he sees two guys on horses with the lances, but they're way out there, And you look at him, and he's sort of walking back and forth very calmly. And then you see the riders, they're coming closer, but it's still way, way away. And all of a sudden, 2 seconds later, they're on him and they spear him. Like all of a sudden they go from here to here, boom. Yep. Okay, that's what I think 2023 is going to look like. Mm-hmm. All of a sudden, my God, now this year, I think 2023 is going to be the chaos year, not the end year.
Well, yeah, it just seems that events and markets are really accelerating, and if nothing else, 2023 and 24 at very least are going to be very interesting and exciting, and I'm sure it'll give us lots more to talk about in the future here, right, Michael?
I think so.
Excellent. Of course, all of your reports and your unique momentum analysis is available at olivermsa.com. And your Twitter handle is at Oliver_MSA as well, right?
That's right. And thanks a lot, Tom.
Wonderful. Thank you, Michael. Appreciate it.
Again. Bye-bye.
Take care. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.